to 𝘠𝘵𝘪𝘶. My name is Mr. 𝘍𝑉𝘋𝘈 and I lecture advanced financial reporting. In our today's session, I want to take you through a topic in advanced financial reporting and analysis known as accounting for insurance firms. Accounting for insurance firms. Then we are going to start with definition of terms. Definition of terms. Definition of terms. Definition of terms. The first term is insurance. The first term is insurance. Then you write below that, it is a contractual agreement. It is a contractual agreement between two parties. It is a contractual agreement between two parties. One called the insurer, and the other called the insured, whereby the insurer agrees to make good the loss, of the insured, in case of occurrence of a specified risk. To make good the loss of the insured in case of occurrence of a specified risk. And then you write below that, the second term is insurer. It is the party who agrees to compensate the insured. It is the party who agrees to compensate the insured in case of occurrence of a specified loss. It is the party who agrees to compensate the insured in case of occurrence of a specified loss. Then we have insured. It is the party who is likely to suffer a loss, from an insurance contract, A party who is likely to suffer a loss from an insurance contract. Terminology number 4 is premiums. It is the amount paid by the insured to the insurer. It is the amount paid by the insured to the insurer as consideration for the risk covered. Number 5 is surrender value. It refers to the amount paid by the insurer to the insured. Surrender value. It is the amount paid by the insured to the insurer as a result of termination of the insurance contract, before its normal maturity period. As a result of termination of an insurance contract before its normal maturity period. That's surrender value. Number 6, reinsurance. The sixth terminology is reinsurance. It arises where the insurer insures a risk with another insurance company. Insures a risk with another insurance company. Which is usually bigger than the insurer. Number 7, commission on reinsurance ceded. Commission on reinsurance ceded. It's an income received from a reinsurer to the insurer. As a result of passing reinsurance business to the reinsurer. The other one, which is the opposite of number 7, is commission on reinsurance accepted. It is a commission paid by a reinsurer. To the insurer as a result of receiving business from the insurer. Full stop. In the books of the reinsurer, this amount is treated as an expense. Then below that, final accounts of an insurance firm. Then you write below that, the final accounts of an insurance firm include the following. Number 1, income statement, or if you want, statement of comprehensive income. And number 2, statement of financial position. We are going to start with the first one. Which is the income statement. Income statement. It is used to show the financial performance of an insurance firm. The financial performance of an insurance firm during a given accounting period. During a given accounting period. Full stop. It comprises of the incomes and expenses. It comprises of the incomes and expenses of an insurance firm within a given accounting period. Full stop. The major, a paragraph below that, the major source of income of an insurance firm, the major source of income of an insurance firm is the amount of underwriting profits. Is the amount of underwriting profits, is the amount of underwriting profit which is determined by preparing a revenue account. Preparing a revenue account as shown below. Preparing a revenue account as shown below. So you are going to write below that revenue account. It is prepared in a T format. On the credit side, we'll have incomes, and on the debit side, we'll have expenses. When you get to the side of incomes, we start with direct premiums received. Direct premiums received. Maybe we can have two types of insurance, maybe fire. Fire insurance covers risk associated with fire, and you can have marine insurance. Marine insurance covers risks associated with sea transport. Associated with sea transport. So you will have fire, you put the direct premiums from fire and marine. Then you add outstanding premiums carried down. You put for fire and marine. I don't necessarily mean that it must be fire and marine. You can even have car accidents. So depending on whatever risks that the examiner has given you, that's how you are going to arrange your revenue account. Then you less outstanding premiums brought down. Then you add reinsurance premiums received. Reinsurance premiums received, so that you less reinsurance premiums paid. And the net figure you are going to get here will represent your net premiums. Then you add an earned premiums brought down. That is at the beginning of the year. It is shall be provided. Then you less an earned premiums carried down. The figures shall be provided. An earned premiums brought down will be appearing in the trial balance, while an earned premiums for an expired risk at the end of the year will be appearing in the additional information. Then you get your totals here. Then you add commission on reinsurance ceded. You add commission on reinsurance ceded. Commission on reinsurance ceded is part of the incomes. It is added there. So that you can have your total incomes. We get to the expenses